So the first chapter that we're going to talk about is called The Demand for Audit and Other Assurance Services. If you've already read the chapter, you'll see that, first of all, it's not a very long chapter. Actually, throughout this book, the chapters are, I would consider, fairly short. So, obviously, if we are going too slow, I would appreciate some feedback in that regard, and we can push through the material a little faster and get through more of the material that way. But if you're comfortable just going through the material at the speed that we have it set down for, that's fine as well. But you'll see throughout the course of auditing that the real substance of auditing is basically an acquired amount of accounting knowledge that you need to have about whatever it is that you're doing an audit of. Now, of course, there's certain auditing standards, and we'll talk about all that. Different types of auditors, different types of audits. But in the end, basically, what an auditor's doing is they are applying their knowledge of accounting, or if they're auditing accounting information anyway. And this chapter describes several instances where an auditor is auditing something else that's totally unrelated to accounting. But if you're auditing accounting information for the purposes of this class, we're going to assume that you are. You basically have to have full knowledge of the accounting principles involved in the information that you're auditing, and then you go through the process of the audit. So, obviously, by the very nature of this class, we're not really going to get into the substantive accounting issues because that knowledge is kind of assumed ahead of time. And what we're going to be talking about more is a description of the profession of auditing, what goes on in an audit, who auditors are, where they work, what they do. And so you'll see that even in doing the homework and taking quizzes and tests, really this shouldn't be a terribly challenging class from the standpoint of needing to learn a whole bunch of new accounting principles that are complicated. It's nothing like an advanced accounting class where you're going super in depth into the most complicated types of accounting transactions. This is more, hey, we assume that you have a pretty good idea of what goes on in accounting, and assuming that you do, here's how the auditing standard. So this is just the general definition of auditing: the accumulation and evaluation of evidence about information to determine and report on the degree of correspondence between the information and established criteria. So basically, you got to have some type of evidence and some type of criteria that you are evaluating that evidence on. And you're basically saying, when we look at the evidence, does this information meet the established criteria, making it reliable information? And from the context of financial statements, obviously the criteria is if you're auditing generally accepted accounting principles based financial statements, that is the criteria that you're using to determine whether or not it's acceptable. So you're looking for evidence to see whether what you've been given corresponds with the criteria necessary to comply with GAAP accounting. And you see here, auditing should be done by a competent, so that's someone who knows both the auditing standards and has a good knowledge of whatever it is they're auditing. So in most cases, financial accounting standards or government accounting standards, if that's the type of audit that's being done. And independence is a key factor that we'll come back to periodically throughout this course, but regular. So here are two items or two types of things that you have to have in order to be able to do an audit. You have to have information in a verifiable form, and this is basically what we're talking about when we say evidence. And then, of course, you have to have some type of standards or criteria that you're using to say whether the information is acceptable. So you look at the information, the evidence that you've gathered, you compare that information and evidence to whatever standard you're looking at, and if the content of the evidence that you see matches the standards that are set out for that particular bit of information, then you can say that that information is reliable. And basically, that is the purpose of an auditor, is to be able to not to say that, you know, these, in the instance of financial statements, these are good, these are bad. No, what you're saying is what you see on the financial statements is an accurate representation using whatever standards we have, so usually GAAP accounting standards, of whatever it's supposed to be reflecting. So financial transactions throughout the year. You know, in the case of a balance sheet, a snapshot of the basic accounting equation. Whatever it is that you are auditing, that's, you know, is it reliable information is what it usually. So obviously, if evidence is one of the two big things that you have to have, then the accumulation of evidence and the evaluation of evidence is a large part of the auditor's job. So these are various places where you're going to accumulate this evidence through transaction data, client testimonies, so interviews with clients, written and electronic communications with members that are outside the firm, and direct observations of processes and whatever else that you can observe while on site. So obviously transaction data is a huge one here. So this is looking at receipts, checkbooks, that kind of thing, making sure all of the tangible evidence backs up the transactions. In order to, well, this basically just sets out, you know, we talked about you have to have competence and judgment and experience. This allows you to, coupled with independence, allows you to evaluate the evidence in a way that allows you to come to a proper conclusion at the end of the day. If any of these competence, independence, and or judgment and experience is lacking, then you may still come to an evaluation of the evidence, or I should say, you will still do an evaluation of the evidence, and you may still come to a conclusion, but the chances that that conclusion is the proper conclusion go down dramatically when one of these issues is or one of these components is missing. Obviously, you know, if you're not independent, that means you have some biases. So you are kind of looking at the transactions through a lens that is kind of tainted, because you either have some underlying interest that corresponds with the client's interest, or the opposite. You have some issue against the client, or you have your interests are aligned with the client's competitors, and so, you know, something that, you know, may be a non-issue, you determine is a huge deal because of your outside prejudices. Obviously, if you're not competent in doing or in accounting principles or auditing principles, then you may think you've done everything right, but that doesn't mean you came to the proper conclusion. Here's a basic example, and I'm not going to read through all this, but basic example of the end result of an audit. So when you read an audit report, you read this audit letter, letter of findings, and generally what you're going for when you do an audit is to have no findings, a clean audit report. This basically says, hey, we evaluated the financial statements or whatever it is we're doing an audit on, and based on XYZ set of criteria, these are accurate and representative of what has gone on, what has transpired, using certain criteria to. So this is an example from the book, just an example of how an audit of a tax return might happen. I don't love that this example is in here just because while obviously an audit of a tax return is a valid example, I think it doesn't necessarily depict the typical type of audit that you would do as an accountant, especially the type of audit that you would do working for an accounting firm. But it does just show you, the various actors in the situation. You've got your internal revenue agent that's theoretically competent and independent. They go through the steps of accumulating information. They have established criteria, which is the Internal Revenue Code. And then they basically will eventually use the evidence that they find, compare it to the established criteria, and come back with a conclusion as to the result of that comparison. So obviously, in talking about auditing versus accounting, you can see that while auditing is often described as a subcomponent of accounting, mainly because a lot of the audits that you hear about are dealing with the auditing of accounting. The criteria that's used in the audit is an accounting type of criteria. So, very often you are auditing financial statements to determine whether they are accurate and representative using GAAP accounting. So, it's very easy to just kind of group auditing and accounting together, especially because the auditor has to have a good knowledge of accounting. But you see, the accounting is when they're recording and classifying, summarizing, basically preparing the financial statements. And then the auditing is when someone's coming in, checking, looking at those financial statements, gathering evidence, comparing the evidence and the end result product to the standards that are supposed to be used to formulate those financial statements, and making a decision and an opinion as to whether those financial statements in this case are representative of the performance of the company using the established. In terms of auditing, the driver of auditing or requiring audits to be done is the fact that information risk can be very expensive. And so what that basically means is information does not have a significant value if you can't trust that information is accurate. So you could, as let's look at it from an investor's perspective. As an investor, you could be the most savvy investor in the world and know exactly how to evaluate a company and exactly what to look for to determine whether a company is going to succeed. But if the information that you're using to make those evaluations is not accurate in the first place, then even though you didn't make any mistakes in your evaluation, you could be totally wrong because you evaluated based on assumptions and numbers that just were not accurate. So information risk is just a risk of making a decision, whether that's a good or bad decision, based on information that is not accurate. And so if you can be assured that the information you're using is accurate, then it alleviates a lot of that information risk, and so it leaves you more to your own skill as to whether you're going to be successful at evaluating and processing that information. So that is the basic drive or driver for auditing services is the fact that nobody wants to get information that's inaccurate because it is of pretty much little to. So these are just various reasons or risk factors associated with information risk. So as these factors go up, you have more and more information risk, and this just kind of amplifies the need for auditing services when you're dealing with scenarios that include some of the. And when you can reduce information risk, obviously you can save money, increase performance. Depending on what your role is and as a user of information, whatever it is, you will do that better if the information that you have is better information. So these are some various ways to reduce information risk, with the key one there that, or I guess it's important to recognize that we do have that audited financial statements are provided there as one of the key ways of reducing. So this is kind of a flow chart as to how each of these players influences the other ones that they have an effect on, and that their business dealings have an effect on. And this kind of illustrates some of the reasons that it's very important to have an independent auditor, but also kind of illustrates the fact that when all is said and done, it's nice to talk about the auditor being independent, but as you can see from this, and this might even be more informative if you kind of traced in there and detailed exchange of money, and so you could better see the financial interests involved. But obviously the client hires the auditor and pays the auditor. And so for the auditor to continue to get business, they need to pay attention to serving their client. But at the same time, very often for an auditor to do their job correctly, they may be trying to play devil's advocate as to the information that the client has given them, because they want to make sure that that information is accurate and representative of whatever framework it is that they are evaluating it against. So that it creates kind of an interesting agency problem, because while the auditor is supposed to be independent, just the simple fact that the client's the one paying them to do the audit, and an unhappy client is unlikely to rehire the same auditor. You have some built-in biases and alignment of interest between the auditor and client that automatically makes the auditor a little bit less independent than probably what is desired. So it's important to keep that in mind, especially as a user of information, because you can see from the examples of audit firms, especially the big one is the Enron and WorldCom scandals. But you can see from Enron where they've got the big name Arthur Andersen accounting firm doing their audit, but you can see that it's very easy once information or once motivations are aligned with each other. It's very easy for the auditor to justify cooking the books a little bit when they're seeing a lot of benefit from doing that, or allowing the entity to cook the books in a way that is not beneficial to the external users. But since the auditor is so closely tied to the motivation of the client, that stuff gets. So apart from auditing services, another service that an auditor or CPA may provide is an assurance service. So these can be don't have to be CPAs that provide these assurance services, but very often the public will seek out CPAs for this type of service. Now, an attestation service is a type of assurance service, and we'll see, and you saw in your book if you read, but there's a little chart that shows the overlap of assurance services kind of engulfing the attestation service. But basically what attestation services are is, a CPA will do a report on the reliability of an assertion. So, one party says XYZ, CPA reviews what this party said and makes an attestation as to the reliability of that assertion. And you'll see when we go into the specifics of the end result, like the client letter and the audit, or the audit report letter, or the report that's done with an assurance or attestation service, that there's specific language that sets out how much you should rely on the information given. So there is, a specific verbiage given in the standards for CPAs and others who provide these services that basically says what to say in order to show that you're this sure that these are accurate. So various different types of attestation services listed here. I don't really want to get into these specifics all that much because we will touch on those a little bit further on down the line, and they're easier to understand when we are actually looking at some live. Web Trust and SysTrust are just IT services that perform attestations. With other types of assurance services, these are some guidelines. No written report required, which is unusual for CPA. Yeah, these are just examples of assurance opportunities growing, and also just the fact that there's sometimes a lot of competition for this type of work, since it doesn't specifically CPA. Some other assurance services that might be provided: assessing the risk of accumulation, distribution, and storage of digital information. Obviously that has very little to do with accounting. So these types of assurance services aren't necessarily accounting related or accounting specific, but oftentimes CPAs will do this type of work kind of on the side, just because of the similarity of this type of work with audits and the fact that there's a lot of overlap there. So if a CPA firm has some knowledge of IT and or other industries, and can combine that with their audit knowledge, that can oftentimes be beneficial toward their assurance services. So here's that chart I was talking about where it shows the overlap of some of these different types of services. Again, this is not a huge deal to pay attention to, but you will see that as we move forward into this class, and you may have seen in other accounting classes, that one of the big changes that the Sarbanes-Oxley Act brought to pass was that generally someone who's doing some of these non-assurance services like the accounting and bookkeeping or tax services for an entity is not going to be allowed to do, in addition to the non-assurance services, some of these assurance and more specifically attestation services. That's one of the things set out, and the purpose of that is basically just to try to maintain a stricter version of independence between the auditing firms and the entities that they're doing. So these are three different types of audits: operational, compliance, and examples of an operational audit: evaluate computerized payroll system for efficiency and effectiveness. And then just this sets out what information you're looking at, what's the criteria that you're comparing it against, and what evidence are you able to pull there. Compliance audit is very often what is done if there's a lot of government regulation in whatever industry you're doing. You want to make sure that any regulatory requirements have been made, or have been complied with. So you're looking at company records as your information. You're looking, in this example, at loan agreement provisions as your criteria that you're comparing against. And the evidence that you're looking at are the financial statements and various other auditing. And the most commonly referred to audit, which is the audit of the financial statements. You're using GAAP accounting as your standard. You're looking at the financial statements and trying to determine whether they comply with GAAP accounting standards. And the evidence that you use is the backup documentation, the underlying documentation that went in to creating the financial statements, along with the statements themselves. XBRL is a type of business reporting language. Deals with tags, tagging the specific data in a certain way, and it enables sorting and comparing of financial data. Also kind of allows for some more IT intensive auditing procedures, which we won't really get into. If you took a accounting information systems class, you would talk more. These are just various different types of people that perform audits. You've got CPAs, CPA firms who are generally doing audits for publicly traded companies. You've got governmental accountability office auditors, and these are working for the GAO, federal office that does the audits for the other arms of the federal government. Then you've got IRS agents who obviously are auditing income tax issues. And then you have internal auditors that are internal employees for various types of companies and or entities. And their job is basically very similar to what an external auditor would do, except the difference is who they serve. Whereas the external auditors are trying to make sure that the information that outside users or information are using is accurate and reliable. Internal auditors their job is to make sure that the information that's being used internally within the company is reliable and usable, and minimize the information risk within the decision makers of the actual company. Anyone who's been contemplating an accounting career is probably familiar with some of the requirements of becoming a CPA. You've got your educational requirement, which at the minimum is going to be a bachelor's level degree with an accounting emphasis. And various states have their own definitions as to what they consider an accounting emphasis. You have to have taken the uniform CPA exam and passed it according to the standards of passing that. And then you have to, pretty much in every jurisdiction that I've seen, every state, there's some type of experience requirement, and that varies significantly. It's most commonly between 1 and 2 years of accounting experience. There are some states that want public accounting experience. There are some states that basically say anything where you have been doing any type of work that could be considered accounting work is sufficient. So it just depends. Some states will say, you have to have been doing accounting work, and a licensed CPA has to sign off that what you were doing was accounting work. So it varies state to state. Very important wherever you're planning on trying to get licensed to thoroughly look at the requirements for that state. Many states have very similar requirements, if not exactly the same. And so for I think it's like 35 states or something, but for those states that are very, very similar, they have pretty lax standards as far as transferring your credential to another state, reciprocity agreements. So if you take the exams and you're licensed in one state, and that state is one of these many states that have very similar requirements, and you move to a new state, generally all it takes to move your license over is to fill out a couple of forms, probably pay $100 or a couple $100, and it's a very short process. Fill those out, within a few days, you're officially licensed in that new state. But it is important to keep in mind that the states that have very drastically different requirements usually do not have the same type of reciprocity available. And so, you should try to think ahead and see, okay, these are the various states that I really would like to see myself end up in, and make sure that, whatever it is you're doing to prepare is sufficient to meet their standards. These are the various sections of the CPA exam, 4 sections. Obviously, the auditing and attestation section deals mostly with what we'll cover in this class. And then you've got the other 3 sections, which is basically covers the subject matter that you would be looking at when doing an audit or an I'm not going to get into the specifics here, because really you need to look specifically at whatever state you're planning to practice in. I think it would be a disservice to look at these and think this is common or the most common way to look at it. I know I recently looked at the Virginia standards, and they're one of the few states that does not require 150 semester credit hours to be licensed. So it used to be most states only required a bachelor's degree, which is essentially 120 credit hours. Now, I would say more than 90% of the states require 150 semester credit hours at least. So that's usually the equivalent of another year of school. And so a lot of the master's programs have been set up in accounting to meet that 30 extra credit hour